Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Market Site studio in Times Square, we have Steve Brown. He's the managing director on Nasdaq's Market Intelligence Desk. And the question we are asking is a recession in question. Steve, it's great to have you with me as always. And August has been quite a month for traders here.
It has. It can be a choppy month because you got a lot of people away on vacation and news happens regardless of what's going on, and it can be a very choppy month.
While it's choppy, volumes have not been quite as slow as they typically are this time of year. There's been a lot of whipsaw action.
We've seen a good bit of volume, and Monday was a little quiet. Yesterday volumes were good. Today volumes will be good. So your volumes have been up, but in this case, it's more fear volume, if you will. Because
right.
People are active, money is moving about, and you're not quite sure where it's going because you have one day looks great, the next day looks kind of ominous, and but volumes are up.
I would imagine market participants are completely exhausted of the market being predicated on a tweet or perhaps a headline coming out of the administration. It's so erratic, and it's not just trade wars, it's not just tariffs. There is a lot going on in the macro landscape, geopolitical as well.
Oh yeah, and that's just it. The markets are forward-looking prognosticator, looking out what's in the future, and it's very, very murky. You could make a case for recession, but you could also make a case, no, we're going to get by just fine, and it will, no problem. And nobody can really give a clear answer. That's the issue.
All right, let's take a look at the charts. Sometimes we get some clarity here. This is the probability of a recession. Explain to us what we're looking at.
This is the Federal Reserve of New York's the probability of U.S. recession predictor. It's kind of going based on the Treasury yields, but as you can see, it's got a very good history. And when we get up to this level, we are probably looking at a recession coming along. It's not guaranteed, but we are up over this level, the highest since the last recession.
Right.
And you take this in with an inverted yield curve and the other things going on, and it starts to feed on itself.
All right, let's look at our next chart, which in fact is the yield curve.
Yield curve. You have the 2-year dipped below, the 10-year dipped below the 2-year this morning briefly, just before I came down, where it's uninverted by about 1 basis point, so not much. And that's one thing I do want to bring up. You want to watch these inversions for duration. An inversion that lasts for 90 minutes is certainly not as powerful as an inversion that persists for 6 months. So that'll be something we'll look at for the next several weeks. But keep in mind, the 3-month bill over the 10-year has been inverted since back in March, and
right.
that's been consistent almost that whole stretch. So we're seeing more inversions, and this just isn't here in the U.S., it's the same thing in the UK. They're looking at that as well. And what happened overnight, there's a lot of economic data, weak data in China, weak data in Germany, weak data in the Eurozone, all coming together to make people think we've got a recession coming. Now tomorrow here we've got retail sales data coming out, and the weird thing is we've had 4 good strong months of retail sales data, so a pullback wouldn't be unexpected, but a pullback this would be at the terrible wrong time, because then it's going to just here we come, more recession talk. Right. So we'll have to see how that plays out tomorrow.
Well, with also the tariffs being kicked down the road to December, or if in fact any talks are happening at all, that's anyone's guess, that would suggest that the consumer's not as strong if we have to push back tariffs so it can be holiday shopping can be affordable. So
well, that's just it, and it's kind of an admission that tariffs are having an impact, and we've seen that in the worldwide data, and it's going to have an impact here because it's raising cost and shifting things around that people haven't expected. But just to get through Christmas and then go back in with more tariffs, you're just pushing the problem out next year. I think it's more of a negotiating tactic from the Trump administration to get China back to talking, but we'll see how it plays out. There are more talks scheduled by phone, and we'll see how that goes. But it seems like both sides are entrenched.
Yeah, and then you also have the political situation going on with Hong Kong. I mean, there's a lot in the macro background.
There's a lot. Political situation there, political situation here, Italy, everywhere else you go there. Yeah. The politics are playing into it. So that's just it. It's not just yield curve and numbers. You've got other stuff, abstract stuff like politics, and it just is a very murky outlook. Not necessarily dire, but I just can't tell you where we're going to be in 6 months. Is it going to look great or just horrible?
Well, I mean, if you're an active trader, you have been looking for this kind of volatility for a number of years now. So there could be some opportunities if you want to have the glass half full perspective. But I agree with you. I think that this could be the environment that we're in for the long.
Well, that is, and for your investors, keep in mind on this. Just because we have an inversion today doesn't mean sell. Because if you look at the stats, a lot of times you'll have the market will pull back 4 or 5% on an inversion, then rally back over the coming months. In some cases, you don't see the market pull back for 6, 7, 8 months out. So there's still opportunity, even with this playing out, there's still trading opportunity.
And if you're younger and if you're a longer term investor and you can acquire shares in your 401ks during these dips, that's the whole dollar cost averaging and compounding. You know, that's a basic investing 101.
If you had sat tight through the Great Recession, just kept investing, you would have made, anything you lost, you would have made it back and then some. So again, it depends on where you are in the cycle, and just keep your nose to the wheel and keep going.
All right, Steve, thank you as always for joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.